This is Jonathan Norris, and I'm doing a presentation on insider trading for ethical leadership at Oral Roberts University. Insider trading has become so prevalent since the 1980s that it's almost expected every couple of years for a new scandal to arise, with greed and power as essential themes. Why do people do this? Why do people act dishonestly? Is it the culture? Is it the pockets of little or no regulation? Maybe it's just an attempt to get ahead in the fast lane of life. Names like Martha Stewart, Michael Milken, R. Foster Winans, Jeff Skillen, and Stephen A. Cohen are famous reminders to the public really not to trust anyone anymore. Even the best and most trusted names frequently fall short when all is brought to light. Insider trading even extends higher than corporations. Charles Lindbergh Sr. wrote about the newly created Federal Reserve back in the 1914, 1915. And he said it will possess inside information as to financial conditions and advanced knowledge of the coming change, either up or down. This is the strangest and most dangerous advantage ever placed in the hands of a special privileged class by any government that ever existed. The system is private, conducted for the sole purpose of obtaining possible profits from the use of other people's money. They know in advance when to create panics to their advantage, and they also know when to stop panic. In other words, behind closed doors, whether governmental or corporate, corruption is always prevalent, and insider trading is no exception in both parties. In this study, we will review some history, some literature, and we'll also talk about some cases and take a peek into the world of insider trading. Starting with probably the top source on insider trading for the U.S., the Securities and Exchange Commission, or SEC, regulates the happenings of insider trading, including the monitoring, policies to follow, and prosecutions to enforce such regulations. Its job is to inform traders, corporations, and the marketplace as a whole in order to abide by certain criteria that would ultimately be dishonest, unfair, or illegal. It requires quarterly and annual filings, proxy materials, and much more from investors in publicly traded corporations. It also requires that if insider trading has occurred, that it's reported within 2 business days, so that it can be reviewed and published to the public, or potentially retracted. The SEC was created after the great crash of the 1920s, after over $25 billion of securities were found worthless, and investors needed a restoration of trust to build back the economy. They created the framework for conducting business in the financial marketplaces of America and helped restore consumer confidence for even the smallest investors. The SEC is probably the greatest source for investors to know their rights and also to protect them from fraud. It's sad to know that if persons like Martha Stewart were more informed, she would not have consented to her investment advisor's advice and respond to insider information. I consider the SEC the police for the financial U.S. marketplace, which also includes its own whistleblowing facilities. They do not offer any interpretation for their regulations, but rather they recommend you seek an attorney's advice for help. Now, before the SEC was created, there was no regulation for insider trading. So we're going to take a look at Banerjee and Eckard's study on insider trading before there was regulation. In this study, Banerjee and Eckard focus on the impacts of legal insider trading from 1897 to 1903, before there was any insider legislation. At the time, there was very little or no regulation for the financial markets. Technology was constantly adapting, and information was limited, even for insiders. This meant that growth in the long term required large capital through businesses' ups and downs. Insiders who worked with trusts to perform M&A deals or other syndicates often had limited information, which was only among themselves. The media had even less information concerning deals behind closed doors, since information on future events or deals was primarily based on trust. And although there was no legislation at this point, an insider told the Chronicle newspaper on May 3, 1902, concerning the International Power Company, quote, "There is the expected decline from $199 in stock price down to $89 over 1 week. I myself have not agreed to sell yet, but I cannot stand the alluring temptation," end quote. Reporting annually or quarterly was not expected to be given to any federal regulators, and at most, earning reports were given to the stock exchange. That was counted as sufficient at that time. They did, however, disclose active information to their investors, as this, although not required, was an attractive feature to investors overall, which certainly brought more capital to shares as a result. This study theorizes that legal insider trading could be more effective, with pricing more accurate and better decision-making possibilities. But what are the ethics of insider trading? Most are divided on the subject, and it's understandable. As I watched PBS's To Catch a Trader, it amazed me how many insiders there are that profit from such information. This minority profiting from the majority undermines a fair marketplace. The use of insider information is based on greed, in which few actually think about the consequences. Before God gave the commandments to Moses, God gave humanity the law of conscience. References Genesis 18:19, Romans 2:15. And before the SEC and its legislations were created, individuals felt the need to share private, insider information publicly about events that were about to take place. In other words, the law confirms that insider trading is wrong and gives others an unfair advantage. However, are there cases where insider information can help? When it comes to the question of legality, Nijat Seyhun finds there's no easy answer to the question whether insider trading should be regulated or not. Each has its own valid points. For example, those for insider trading claim by making markets more liquid through insider trading, they also encourage short-term trading mentality rather than favoring long-term investors, as well as a greater information efficiency. When we look to the crash of October 1987, it's a really interesting case in which Seyhun studies for actually a large section of his book. There still exists a large disagreement over what caused the crash of 1987. However, there are 3 scenarios likely that Seyhun points out. Insider trading occurred before, during, and after the crash. In fact, a large part of wariness from investors was due to numerous SEC investigations of illegal insider trading earlier that year. Seyhun describes the insider trading patterns throughout the timeline. He found that many insiders purchased firms in response to the crash, that the use of insider trading actually served an important public interest by stabilizing stock prices. that stocks outperformed after the crash due to insiders, and that insiders did not rely too heavily on the amount of the stock price declines. In other words, they knew ahead of time, and they helped stabilize the market. Surprisingly, insider trading in this case created greater consumer confidence and liquidity in the marketplace. Thus, insider trading could have its purposes if, on a larger scale, such as the crash of 1987, occurs again. It is possible. Let's take a look at a few cases that we may know, such as Martha Stewart and the crash of 1987. Losing over 22.6% or $500 billion in one day is defined as the largest one-day market crash in history. This was known as the stock market crash of 1987. It all began with the increase of shady deals, IPOs, insider trading, and M&A deals, which made the SEC conduct many investigations earlier that year. That, along with the market booming or inflating, depending on your position, made for a weary investor, hoping that inflation would not tip the scales against their favor. Markets around the world also plummeted. Stories of individuals shooting up broker offices were heard of, and investors would sell because everyone else was selling. Fear and panic gripped the market, even giving opportunity for the Federal Reserve to step in and attempt to save the crash. Other causes for the crash included computer-traded portfolio insurance. This meant that if the stocks declined a certain amount, it would automatically sell off. Not only that, but people would hedge against risk through this insurance and other commodities. However, no one thought of the effect of mass selling or hedging would have on the marketplace. Selling would keep reducing the prices, resulting in more selling, which resulted in reduction of prices, which resulted in more selling, and you get the picture. Insider trading between January and August 1987 included 170 million shares being transacted. In October, after the crash, over 70 million shares were purchased, resulting in over 300% of profits for insiders who had knowledge and took advantage of the event. Mainly, these insiders bought up stocks in their own firms, which they worked in, and they waited for the marketplace to drop in order to buy in. Insiders, and more specifically, top executives, were found to have a greater ability to predict the market than the average investor in 1987. In fact, insider trading that occurred became a good indicator of future results. This, strangely enough, helped restore confidence in the market and liquidity, as mentioned earlier. This massive company of insider traders most likely helped lead the way and preserve the markets from utter destruction. The lesson learned in 1987 was when a lot of people panic, it pays to know what the insiders are doing. Let's take a look at Martha Stewart as an individual example of insider trading. Even though many insiders can get away with their transactions, it's unfortunate that persons such as Martha Stewart just can't get away clean. Martha Stewart became aware of her investigation with the sale of ImClone Systems Incorporated in December 2001. She ended up serving jail time for 5 months for obstructing justice and making false statements. Not insider trading, however. Truth be told, she actually settled her case for insider trading outside of court. However, she did trade on information that was not yet public or material. Martha Stewart not your typical insider, having no duty of trust and confidence to the shareholders of uncloned systems, did receive information somehow through an insider, most likely her financial advisor at Merrill Lynch. Since she was involved in the tipping of information that would benefit her or others, and she took advantage of it, this conduct is improper and violates investors' trust. Even though she could be found guilty, legally she is not considered an insider trader in the court's eyes, since she made a deal with the SEC beforehand. She was never found guilty, and if the SEC would have pursued the case, it still would have been difficult to prove because of the interpretation of the Securities Exchange Act involving tippies or tippers of non-public information, non-material information. Instead, most cases of insider trading are judged according to past court cases and interpretation of very broad legislation. Even though the public may deem her an insider trader, technically, she's innocent of all charges. The lesson we can learn from her story is to never underestimate the damage one wrong decision can make, even behind closed curtains. In conclusion, there are really positive and negative effects of insider trading. From a moral perspective, generally insider trading is wrong. For now, the SEC has ruled it illegal, whereas in the future, with more study, it could be deemed reasonable with some exceptions and rules. As in the case of the crash of 1987, the mass usage of insider traders who had knowledge about the event and could foresee it actually helped stabilize the marketplace and help recover the market. It seems to me that insiders are somewhat necessary, but to what extent, I've not concluded. Thank you very much.